Out of the millions moving money through the Japanese stock market, one individual earned a level of respect and wealth bordering on the mythic, Takashi Kotegawa. Among local traders, he is known as the god of trading. Online, he posted his moves under the username BNF. In the financial press, he became famous as the JCOM man after spotting a clerical error in 2005 that handed him a massive overnight windfall. His story begins in the year 2000. At 22 years old, Kotegawa scraped together his entire savings, roughly $13,000, and placed his very first trades in the market. He entered at a time when the Japanese economy was locked in a persistent bear market. Most investors were watching their portfolios steadily lose value month after month. While others were looking for a bottom that never seemed to arrive, Kotegawa focused on finding a mathematical way to profit directly from the volatility of the decline. This diagram shows his primary tool. The central line is the 25-day moving average, which serves as a benchmark for a stock's current fair value. Kotegawa treated price movement like a rubber band. When a stock price drops sharply away from its fair value average, tension builds. He set a rigid rule for himself. If a stock fell 20% or more below that 25-day average, he would open a long position and buy. He was betting on a reversion to the mean. The moment the price snapped back toward the average, he closed the position and booked the profit. By systematically buying the panic and selling the bounce, he created a framework that turned market fear into a predictable advantage. The initial 20% rule wasn't a perfect solution. These specific opportunities were rare, and his early attempts often resulted in missed entries or small losses. During the lead-up to the 2008 financial crisis, he realized that in a systemic crash, stocks don't just dip. They can plummet 60 or 80% below their averages. He refined his approach by studying how different sectors reacted to stress, adjusting his buy triggers to 25, 45, or even 60%, depending on the industry. Throughout Japan's lost decade, he repeated this cycle on hundreds of different stocks, compounding his gains as he mastered the rhythm of the market. This consistent application grew his $13,000 into $1 million by the year 2000, and by 2008, his capital had snowballed into the multi-millions. In 2008, he decided to branch out and opened a separate account to trade the US market for the first time. He took a massive $6.5 million position in Lehman Brothers. At the time, they were a pillar of American finance, similar in scale to HDFC or ICICI in India. The stock had already crashed 70%. According to his bounce theory, the mathematical probability of a recovery was at its peak. Instead of a bounce, the bank collapsed. The bankruptcy wiped his $6.5 million investment down to zero. He closed his U.S. accounts immediately and moved his focus strictly back to the Japanese sectors he had spent a decade studying. By October 2008, the Japanese Nikkei index was in freefall, dropping 42% below its moving average. On October 27th, while institutional traders were frozen by the crash, Kotegawa deployed his remaining capital in a $64 million, or 544 crore, all-in long position. The market dipped even further the next morning. The tension of holding a $64 million losing trade during a global financial meltdown was nearly unbearable. After the lunch break in the Japanese session, the selling finally stopped and the market soared. He was up $12 million in a single day, but he refused to sell, holding the position overnight. The following morning, the index gapped up and formed a massive Marubozu candle, a sign of pure buying strength. The market rallied 7%. By sticking to the math while the rest of the country panicked, Kotegawa walked away with one of the largest personal trading profits in history. After 2008, he moved much of his wealth into Tokyo real estate and made early, significant investments in Bitcoin. He remains a recluse, avoiding the media and managing his multi-million-dollar empire entirely through his personal accounts, rather than trading with other people's money. His wealth was built on a foundation of personal accountability and solitary execution. Kotegawa calls himself a bear trader. His success was built on the discipline to follow a set of mathematical triggers, even when the broader market was in a state of total paralysis. Whether you are trading stocks or using platforms like CoinDCX for crypto SIPs and leverage, a plan is only effective if you have the discipline to follow it when the market tests you. Every trader has a strategy, but few can stick to it during a crash. How long have you been trading, and how has your discipline held up? Let me know in the comments.